So let's take the practical example of a cash flow statement. Poshak Limited is a company manufacturing a specialty chemical in India. In fact, it is a monopoly player in that specific chemical. What we will do is we will look at a cash flow statement of a real world company to understand the cash flow from operating activities. First of all, in India, the cash flow statements, the year ended on 31st March 2020. That means the year or the period for which we are looking at the cash flow statement is 1st April 2019 to 31st March 2020. Now, the rupees doesn't matter which currency it is, we are just here to do the analysis. So let's first understand what are the cash flow from operating activities. Like I said, we take the net profit before tax. That means that we are basically taking the net income before tax when calculating cash flow from activities. In our example, we had taken net income after taxes. Here it is taken before tax. It doesn't matter really because we will take the tax effect in the later portion of the cash flow statement. So we started with the net profit. Then we adjusted what? We adjusted our non-cash expenses. Now here are 10 items. So can we see what are our non-cash expenses? Depreciation is definitely a non-cash expense. But interest income, dividend, these are not non-cash expenses. Definitely if we are paying interest, then if we are paying income or if we are receiving interest income, then definitely our cash is being increased or reduced. So why is it written here? Let's go down and I will tell you what is the situation here. So depreciation has been added, that makes sense. Interest income doesn't make sense. Dividend income doesn't make sense. Unrealized foreign exchange loss. This is something which does make sense. But why is it here? Because this unrealized foreign exchange loss is actually a journal entry. The profit or loss of the foreign exchange is already covered in the closing cash balance. That's why this figure is written here, because it is a non-cash expense. The sixth one is a loss on sale of property. This is more of an investment thing. Profit on sale is again an investment thing. Profit on redemption of investments, fair value change of financial investments, and rental income. So if you see very closely from point 1 to point 10, the non-cash expenses only consist of point number 1, depreciation, point number 1 and point number 5. The rest of the points from point 2 to the rest of the points are actually all cash expenses or cash income. So why are they being added or reduced back in these adjustments? Because all of these will be covered either in cash flow from investing activities or cash flow from financing activities. And that is the reason why this interest charge, this interest income is being reduced here, because this interest income will be taken later in our financing activities. This whole interest income will be written downstairs, because this is interest income has been received from our investments made, and this will be included in the cash flow from investing activities, as we can see here. Since we are taking it in the cash flow from investing activities, we have reduced it here. Same goes for your loss on sale of property, plant and equipment. This is an investing activity item. This item will be covered in the investing activities. So that is why it is not covered here, and so on and so on. So we get operating profit before change in working capital to be 4,285. Now comes the working capital changes. As we have discussed before also, we take the decrease in adjustments for increase decrease in operating assets, adjustments for increase decrease in operating liabilities. So what are the operating assets, or basically our current assets, and what are the increase or decrease in our operating liabilities? Now in this case, in Indian context, they take the non-current items also. But when it comes to analyzing your business, I do not believe this practice is correct. We shouldn't take the non-current assets and liabilities in our cash flow statements. But this is how some Indian companies are doing it. However, I am not in this favor. According to me, this figure of 408 and this figure of 43 should not be included in the cash flow statement. So I suggest when you are making the cash flow statement of your business, because it's an operating activity statement, we shouldn't take long-term assets or long-term liabilities in these calculations. Besides these figures, Let's see what other figures have been provided. So the first one is inventories. It says inventories, and here it's plus. That means that inventories have basically reduced. Why I said that? Because if the current assets have been reduced, then it will result an increase in our cash flow, which is the case here. And this can be confirmed when you go to the Poshik balance sheet. In the Poshik balance sheet, we can very clearly see that the inventories have reduced from 1789 to 1625. So this difference of inventories is basically written as decrease in operating assets and written here. The same goes for trade receivables. Now when you look at the trade receivables have again been reduced from 3246 to 2118. Again, the trade receivables, since they have decreased, thus decrease in figure has been written as increase in cash flow in our cash flow from operating. The third one is the short-term loans and advances. Now the short-term loan and advances comes under current assets, and we can see in the current assets we have other current assets. So this reduction in other current assets from 273 to 171, or almost 102, this has resulted an increase in cash flows. So all these figures are actually taken from the balance sheets. Now, one more thing, important thing to understand, these current assets, what are the things which we have not taken? So in current assets or the operating assets, we have taken our inventories, we have taken our trade receivables, we have not taken cash and cash equivalents. Why? Because when we are calculating the cash flow statement, we start with the cash and cash equivalents at the beginning of the year. We take the effect of all these cash flows of operating, investing and financing, and we get our cash flow, cash and cash equivalents at the end of the reporting period, as can be confirmed from these two figures. So if you add cash and cash equivalent and bank balance, you will get the cash flows closing balance. So that's why we do not take the cash flow figures. Other current assets we have already taken. Current tax assets is something which is not required to be taken here. So we have not taken the main financial assets. Why? Because these investments will come part of investing activities. Like I said before, they are taken other non-current assets in operating assets, which I don't think is the right treatment or accounting treatment. We should avoid these when you're trying to analyze the cash flow from operating activities. Let's take the cash flow statement of a company which we all know. Let's take the cash flow statement of Amazon. Now this is the cash flow statement of Amazon on 31st December 2020. As we can see, the opening cash balance of Amazon on 1st January 2020 was $36 billion. We start with, like I said, net income or income after tax. That comes out to be around $21 billion. Then we add all the non-cash expenses and those expenses which are part of investing and financing activities. So what we do is, we first add the depreciation as it is a non-cash expense. We add back the stock-based compensation, because stock-based compensation implies compensation via stock. That is, no cash is required to be paid. So we add back the stock-based compensation. We took the other operating expenses income and other expense income and deferred income taxes. Why we have taken these three figures? Because these three figures are not part of the operating activities. It literally says other operating. So this is not basically your operating expenses or operating income, and they have been taken out of here. Your deferred income taxes, like I said, it's a journal entry and needs to be taken out. Finally, we come back to the working capital. So change in operating assets and liabilities. So we have your inventories, your debtors, your creditors, your accrued expenses, and your earned revenue. That is basically the revenue received from your customers, which you have not yet earned. That is a liability. So if it says inventories is minus, what does it mean? It means that Amazon during the year has additional inventory of $28 billion, because the figures are in millions. So 2,849 million means $28 billion. So that means that Amazon has purchased additional inventories of $28 billion during the year. And that has resulted in a negative cash flow of $28 billion. Account receivable has increased by $81 billion. Why? How can I say that? Because it's a negative figure. That means that the debtors have increased. That is, debtors have not paid and they have received our goods and services. Our means Amazon goods and services. So that's why Amazon has basically blocked its cash in these debtors, so or in the account receivables, and this has resulted in decrease in debtors, and this has resulted in decrease in cash flows. This increase in accounts payable means that Amazon has effectively received goods and services from its creditors or from its suppliers without paying any amount to them. So that resulted in increase in cash flow of $17 billion. Accrued expenses simply means other expenses. That means we have increase in expenses, increase in liabilities, and this has resulted in increase in cash flow. So all these figures, see what happened. The net income was just $21 billion. And what are the cash flows provided or cash flows from operating activities of Amazon? That is $66 billion. So what does it show you? It shows you that the major components of Amazon business is actually hidden. Hidden in what way? It's hidden in its excellent management of its working capital. Amazon is very well developing or very well managing its business because it is effectively using suppliers' credit to grow its business. These two figures, basically shows the amount extra taken or amount extra expended or cash flow negative in debtors and inventories. But look how much creditors, how much suppliers credit Amazon has been able to take in this year. So this has resulted in huge cash flow amounts of around, I would say, $7 billion increase in cash flows. This coupled with depreciation, which basically just shows just a wear and tear proxy. Like I told you in income statement, depreciation is a proxy for the repair and maintenance. It is not an actual expense. So this $25 billion actually increase our cash flow. So this has actually resulted in our $21 billion income, $20 billion income to be converted into $66 billion of pure cash flow from operating activities. And this is not a 1 year case. Amazon consistently do this. Amazon's profit income was only 11 billion and its cash flow from operations 38 billion. That is why Amazon is a cash machine, because Amazon, even though it shows that it has low operating income or a low net income, but in reality it has huge cash flow from operations which it can use to expand its business.